According to a recent report, American companies are buying back their own stocks at an unprecedented rate. This trend has been fueled by the 2017 Tax Cuts and Jobs Act, which lowered corporate tax rates and made share buybacks more attractive. One key catalyst for the surge is the low interest rate environment. With borrowing costs at historic lows, companies can easily finance their share repurchases without breaking the bank. Additionally, the strong economy and rising stock prices have created a sense of urgency among executives to boost earnings per share by buying back shares. Data points suggest that share buybacks are becoming an increasingly popular tool for companies to return value to shareholders. In 2020, companies in the S&P 500 spent $652 billion on share repurchases, up from just $157 billion in 2013. This represents a staggering 315% increase over the past 7 years. Furthermore, research by Goldman Sachs found that in Q4 2020, S&P 500 companies spent an average of 45% of their quarterly free cash flow on buybacks. The trend is expected to continue, with many analysts predicting that share buybacks will remain a key driver of corporate spending in the coming years. Some notable companies that have been actively buying back their shares include Apple, Microsoft, and Johnson & Johnson. For instance, Apple's $90 billion share buyback program announced in 2020 is one of the largest in history. However, there are risks associated with this trend. Share buybacks can be seen as a sign of desperation or lack of investment opportunities rather than a sustainable way to create value for shareholders. Furthermore, the increased demand for stocks could lead to higher prices and reduced liquidity in the market. A study by the Federal Reserve found that between 2010 and 2020, share buybacks accounted for nearly half of all corporate equity issuance. For investors looking to capitalize on this trend, some tactical ideas include buying into companies that have a history of generous share repurchases or those with strong cash flow generation capabilities. For example, Apple's recently announced $90 billion share buyback program could provide an attractive entry point for investors. Another option is to focus on sectors where companies are most likely to continue buying back shares, such as technology and consumer staples. Takeaway: American companies' record pace of buying back their own stocks is driven by tax cuts and low interest rates, but poses risks to market liquidity and long-term sustainability. While share buybacks can provide a short-term boost to earnings per share, investors should be cautious about the potential long-term consequences on corporate investment and innovation. It's also worth noting that some companies are using their share buyback programs as a way to offset dilution from stock option grants and employee equity compensation. This can help maintain a stable shareholder base and support long-term value creation. However, it's essential for investors to carefully evaluate the motivations behind each company's share buyback program and consider the broader implications on the market. In conclusion, American companies' record pace of buying back their own stocks is an intriguing trend that warrants close attention from investors. By understanding the drivers and risks associated with this phenomenon, investors can make more informed decisions about their investment portfolios and potentially capitalize on opportunities arising from this trend.